Fixed income remains a hot topic, especially as markets continue to diverge. With new legislation potentially on the horizon and a Fed that is paying very close attention to rates, how are municipal bonds positioned for what's ahead? We're going to explore recent moves, policy watch points, and the muni investment outlook right now on UBS Trending. Hi, everyone, and thank you so much for joining me. I'm Anthony Pastore, and this is UBS Trending. I'm pleased to welcome my guest, a very good friend of us here at UBS Studios, Dave Hammer from Pimco. Dave, good to have you back, and great to have you sitting here in the studio with me.
Good to be back in person.
Yeah. Munis are such an interesting story. I mean, fixed income in general has been a really interesting story. You know, just to coin a few friends of ours in the industry, they're saying, you know, fixed income is kind of like a hot and sexy asset class these days just because of the moves we've seen. And munis really are also just a really interesting asset class right now. If you look at the way, and I'm telling you this, and you know this better than anybody, the performance that we've seen over the last couple months, you know, we've seen, you know, some sell-offs, historic sell-offs from munis. What's going on? What's the reasoning behind these strong sell-offs that you're seeing?
Yeah. Well, munis tend to become more interesting just after a sell-off, and this year's been a pretty tough year for the muni market relative to taxable fixed income. So coming into this week, taxable fixed income indices were up 2.5%. Muni indices were down 1 to 2%. And the big driver, there's a few of them, but we'll start with just what is very predictable, which is weak seasonals. So munis tend to underperform in March and April as our clients take money out to go pay their taxes, and this year was no exception. The second is that macro volatility in the backdrop of tariff announcements in April, interest rate volatility went up, credit volatility went up. We tend to see decent retail redemptions from the muni market during these periods. Again, this was no exception. So there were 8 weeks in a row of outflows from the muni market. That also coincided with many muni issuers rushing to market to get ahead of a potential change in tax policy. So many private activity bond issuers, private higher ed issuers, they were worried that they might lose the ability to issue more tax-exempt debt in the future. So they pulled forward new issues. So new issue supply up 25% year over year. You put all of those things together, and munis had to cheapen up substantially to draw in crossover capital, total return-oriented investors to step in and begin to buy.
Wow. Yeah, and it's not surprising to hear you say our chief investment office here, our muni team, does have a most preferred on munis right now. They've sort of remained that way, and they see there's opportunity there, like you're talking about. But kind of so we're actually you and I are sitting here. The tax bill is going to the Senate. It's already been passed by the House. We can expect that the deficit will likely increase, although as your own Libby Cantrell told me back even before the election last November, no matter who won the White House, there was going to be an increase in the deficit. Are there any key policies that you're watching that could maybe impact the muni market from that potential tax bill if it does get passed by the Senate?
Yeah, so I think the good news for the muni market is there's not much in there that affects it. So I think the fear was that the government would use the muni market as a pay-for, either by restricting issuers from doing new bonds, or potentially putting some sort of cap or tax on existing muni bonds. We didn't think that was going to happen, and it looks to be very unlikely at this point because the bill's moving through. What is in there? There's some things that affect credit quality overall. So I'd say the number one is a reduction in Medicaid funds. That's the highest percentage of federal revenues that gets distributed to states in an ongoing year. Somewhere between 5 and 10% of state budgets. Now the good news is state and locals are in the strongest shape they've been in 25 years. Rainy day funds reserves are 3 times what they were pre-COVID. So, we see this as a little bit of a headwind, but really not a material credit event. The biggest impact on the market was probably the anticipation of this bill, which brought in all this issuance and pushed prices lower. Maybe just one thing I'd add is that we're very focused on the Harvard situation and the threat for them to lose their tax exemption. I would just draw a really key distinction here. That's not through a change in policy. That's through a change in the IRS interpretation of them as a tax-exempt entity. We think there's some risk there that really isn't in the price today. If they were found to be a taxable entity, We think most likely their outstanding muni bonds, the income would become taxable, and that would be a pretty significant hit to the market value of those bonds.
Yeah, I mean, and is that something that you're telling your clients to try and at least keep an eye on for now? Or are you telling them to kind of avoid investing in that space? What are your thoughts on that?
Yeah, it's an area that we've de-risked.
Yeah.
As an investor, we want to be paid additional spread for this risk premium.
Yeah.
It's not really in the market. It's not a credit event. So on the taxable side, we've seen many of these universities come to market in anticipation of federal funding cuts, and they're borrowing in advance to fund those, and otherwise they may have to tap their endowments. We've actually seen those as good opportunities to buy in the taxable market. So it's not a credit event. It's really specific to these tax-exempt issues.
Okay, thank you, Dave. So where are we now in terms of muni valuations specifically? It looks like the tax bill is going to get passed, right? It seems like it's almost a foregone conclusion at this point. So how does this position munis for forward-looking, and also thinking about the back half of the year, we do expect that the Fed, or CIO anyway, expects the Fed is going to start cutting in September, 100 basis points between September and sometime in mid 2026. All of that considered, where are valuations with munis right now forward looking to?
Yeah, so you're just kind of building up from a macro perspective. I think U.S. rates are pretty attractive, probably a little bit higher than they need to be, given our base case forecast of about 0.7% real GDP and inflation kind of the mid to high threes. We do think there's some room for the Fed to cut as the economy likely slows.
Right.
Munis are actually relatively cheap versus treasuries, versus corporate bonds, versus mortgages.
Right, and credit quality looks still pretty robust here, doesn't it?
Yeah, muni credit quality overall,
Yeah.
It really is the best shape it's been in many decades.
Yeah, it's
and
incredible.
the short story there is that the federal government allocated a lot of pandemic relief, expecting tax collections would decline by 10 to 20%. Property taxes, sales taxes, income taxes. What's actually happened over the last several years, tax collections have increased by about 35% on average. Inflation has actually helped in many cases.
Sure.
Now, this isn't true everywhere. There are some specific issuers that we think credit quality's peaked. They may be relevering. Kind of the riskiest parts of the lowest quality of the high yield muni market, we actually think is very unattractive. Spreads there are near all-time tights versus investment grade munis. But the credit quality of the market, by and large, even if we see a harder economic landing, a sharper slowdown, we think the muni market's in a good position to perform well through that period.
Yeah, that was going to be my question for you is, what's the conviction behind whether we think, if there is going to be a slowdown in the U.S. economy? We don't expect a recession at UBS, but we do expect that things will slow down a little bit. Fundamentally, are munis prepared to handle a slowdown if that's the case? Seems like the answer is yes.
Yeah, I'd say the answer strongly is yes.
Yeah.
I'll use California just as a simple example, where I live now. And my credit team would have told us back in 2018 that California's rainy day funds and reserves had been rebuilt from the financial crisis. They were in the best shape in 20 years. Those rainy day funds and reserves today are 3 times what they were in 2018.
Wow.
So exceptionally strong credit quality. Then as we look ahead, a lot of what state and local governments spend money on, it's infrastructure. And the federal infrastructure bill that was passed, it's just beginning to flow through the system. The number one GDP scored project is the Gateway Tunnel connecting New York and New Jersey. So here locally, and we're beginning to see progress on that. But about 80% of infrastructure finance, those dollars come from state and local government balance sheets. And so looking ahead, all of that infrastructure money that's flowing in will help them even a little bit more.
Yeah, thank you, Dave. Before I let you go, though, a lot of our clients are focused on what's happening in the treasury markets, and you're looking at rates. The long end of the treasury curve is starting to really kind of peak up a little bit. You got 30-year, like a 5.10 or so, and 10 years are at about a 4.60. How much does the movement in treasuries impact munis, if at all?
Yeah, so it matters. It's an interest rate sensitive product. I would say the big distinction here, the deficit will grow at the federal level.
Sure.
State and local governments run balanced budgets. So it's a very different, credit picture, but certainly there's a correlation to interest rates. Yields are already pretty high. So if you look back to 1998 to about 2006, when the 10-year treasury was moving around between 5.5% and 6.5%.
That's right.
The yield on the IG Muni Index was on average somewhere between about 4.5 and 5. It's a 4.10 today.
Oh.
So even in an environment where rates, it's not our base case, but if rates did move, significantly higher in the treasury market, I'd say a lot of that is already in the price of munis today.
Excellent. Dave, thanks so much. Good to have you join us. And I know coming in from California to meet with us is a great thing, so good to have you here.
Great seeing you.
Great.
Thanks so much.
Dave Hammer from Pimco. Thanks again, of course, to all of our great partners at Pimco. We love working with all of you, so thanks for joining us. And thank you, our audience, for being here. If you want more information on everything coming out of our Chief Investment Office and our great partners like Pimco, you can visit our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook, as well as Instagram. Follow the studio. Our handle there is at UBS Trending. Lots of great content there for you. And if you have any questions about what Dave and I spoke about today, please make sure that you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Wish you a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon, everybody.